Dear students, coming back to financial management, today's session we will start with the fourth module, working capital management. We had gone through in the previous videos three modules. One is the basics of finance and time value of money, and the second one is capital budgeting, which deals with long-term capital assets. And the third module we had dealt with dividend and profitability decision. So capital budgeting was all about long-term asset mix, and dividend decision was all about profitability and dividend mix. Okay, and today's session we will be dealing with working capital management, which is the fourth module as per our syllabus. You all had studied working capital. What is working capital? Current assets minus current liability is working capital. But when we take into account the working capital management problems and we go in depth of the working capital management portions as a part of financial management studies, we have to know certain financial terminologies like what is net working capital, what is gross working capital, and what are the various current policies used for working capital, how do we estimate the working capital, what are the factors affecting working capital, what is operating cycle, etc. So in this video we will be dealing with all those things. Let me first explain what is working capital management. Working capital management is deciding upon the optimum level of current assets. So make it very clear, it is deciding upon the optimum level of current assets, or we could also specify it as working capital management is all about short-term asset mix. What is this short term? As I had already mentioned, it is current assets and current liabilities where the short-term funds are met with. So from the current assets and current liabilities, difference if we take, that is called as net working capital. Then what is gross working capital? Current assets alone, we could call it as gross working capital. In working capital, we are actually studying three things: management of current assets, management of fixed assets, and management of sales, because these three things are very vital. It is not studying all about the current assets alone. Current assets is closely interlinked with the fixed assets invested in the business. When you could see this graph, small graph, that is the output of the organization is given in the x-axis, and y-axis you could see level of current assets. If the company is maintaining lower current assets to fixed assets, that is if the company is maintaining lower current assets to fixed assets, it is having actually an illiquid position. Why? Because the current assets are low when compared with the fixed assets. It's a part of illiquid position. Current assets are low when compared with fixed assets. That is what current assets, lower current assets to fixed asset ratio we will find out. That is when we draw this graph, the level of current assets, you could see that this permanent line, straight line, is all about fixed assets. Fixed assets in an organization will be keeping it as constant. Then with this fixed assets, they will try to lever the current assets. It is all about the working capital policy adopted by the organization. I will make it very clear. The output of the organization is given in x-axis, but the level of current assets is put in the y-axis. By keeping fixed assets a particular proportion, the current asset position is adjusted or levered. It is how the working capital policy is found out. Okay, that is you could see the first line, higher return and higher risk. What it indicates, that is the line passes through the fixed assets, higher return and higher risk. That is investment is more in fixed assets whereas current assets is very low. Okay, that position is no aggressive policy taken by the organization in the part of working. This aggressive policy I'm talking in the part or from the angle of working capital. So an aggressive policy organization is an organization where maintaining a particular portion of fixed assets, the current asset leverage is less. That is, the company is floating its or pumping its money from the fixed assets with the support of high support of fixed assets, and lower current asset investment is made, then it is called as aggressive policy taken by the organization. That means the company is illiquid. Why it is illiquid? It is not having much current assets. That is what lower current assets to fixed asset ratio. Then the company, in the reverse you just take, the company is maintaining less fixed assets. You see, angle is very less fixed assets with high current assets. What will happen? The return will be less, but the lower the return will be less, and the risk will also be less, and the company is earning the income. It is called as conservative policy of maintenance of current assets or working capital management. In between it comes average policy. So this structure you should be very thorough while studying the working capital management, whether the company is following conservative policy, whether the company is following aggressive policy, or the average policy in the maintenance of working capital. Once more I will tell, the company may take the short-term asset position based on the availability of fixed assets or the amount invested in fixed assets and comparing it with current assets. The company could either maintain a lower current asset to fixed asset ratio, higher current asset to fixed asset ratio, or in between. These are the three policies adopted by the organization, where the organization may work either in a conservative policy if it is higher current assets to fixed asset ratio, and the company may be following an aggressive policy if it is with lower current asset to fixed asset ratio, and if it is in between, it is average policy. So this thing you should be thorough by looking into the policies adopted by the organization for the maintenance of adequate working capital. The company could decide which policy they have to adopt. Based on this, there are problems also. That at that time you could make it more clear than people who are confused with the graph. They could understand well while looking into the problems. So as you all know from the degree class onwards, you are studying that working capital. What is working capital? It's all about maintenance of current assets and fixed assets. Current assets minus current liability, we will have net working capital, where the management will use that fund for the regular purpose of business. Now another thing is that you have to study is what are the factors affecting working capital. As you all know, it's all about the current aspects, not fixed aspects. Nature of the business may affect working capital. Production policies may affect the working capital. Credit policy may affect the working capital. Manufacturing process of the organization may affect the working capital. And technology and manufacturing process or policies may affect the working capital. Sales and demand conditions may affect the working capital. Terms of purchase and sales may affect working capital. Operating efficiency and availability of credit may affect the working capital. Availability of raw materials, price level changes, taxation policies, all may affect working capital. Why? It's because if you look into the operating cycle, you could understand that working capital is required for any organization for the day-to-day operation. It is not like fixed assets. Fixed assets are for permanent purpose, but working capital, what is it? It is required for the day-to-day operation. what we will do in the manufacturing cycle or operating cycle, you look into if it's a manufacturing company, how we manage the working capital. First of all, for productions, okay, we may assume that's a manufacturing company. For production, we may acquire raw materials, isn't it? So the acquisition of resources is very important. No, we will acquire inventory. How do we acquire inventory? We may purchase it for cash, or we may purchase it for cash, or we may take it on credit. So from creditors, we will take inventory. When we purchase on credit, automatically creditors are generated, isn't it? So inventory is there. From the inventory, what we do, we will go for production process. So that is the second stage, production process. We will acquire the resources and go for production process. While entering into the production process, what will happen to the inventory? Inventory will be converted into finished goods. But this inventory investment will be in three ways. That is, inventory will be in the form of raw materials. Inventory will be in the form of work in progress, because some inventories will be in the production process, and inventory will be in the form of finished goods. So inventory itself, from studying deeply the working capital management process, inventory will be classified into three: raw material, work in progress, and finished goods. Okay, and so this is acquisition of raw material or sources. We will convert it into finished goods. And what will happen now? This finished goods, we have to sell it in the market. So it have to be sold out. Okay, so sales may happen in two ways. It may be sold out on credit basis, and it may be sold out on cash basis. If you are selling it on credit basis, the debtors will arise. And if you are selling it on cash basis, immediately we will get the cash. If we get the cash, our credit settlement could be immediately met out, because we might have purchased goods or raw materials from various suppliers on the basis of credit. We have to settle them. So that is the cash could be used for settlement. So this process is continued. So this is known as operating cycle. What is it? We will acquire the raw material, we'll put it into production process, we'll get finished goods, we'll go for selling it of the raw material. The cycle is continued. So in this cycle, it's very important that all stages we require liquid assets or cash, because debtors, it's a liquid asset, isn't it? Bills received, etc. may rise. It's liquid asset. At the same time, creditors have to be offsetted. Okay, raw materials, it's going on production process, we may require money. These are all the things what we are studying under the working capital management. So what is working capital management? Working capital management is all about studying about short-term asset mix. Whereas capital budgeting, we had studied in the earlier module, in the earlier videos, we had studied capital budgeting is all about long-term asset mix. We are finding out there the long-term finance, how it is used, how the projected investments will get the return. But in working capital management, we are studying about short-term asset mix and finding out the net working capital, current assets and current liability, and finding out the policies adopted by the organization in maintaining the working capital financing, working capital financing. So these are the things which you have to know, theoretical side of working capital. And one more point I will explain, that look into this chart. There's a time working capital, we will keep the permanent working capital based on this. So every organization should have a particular portion of permanent working capital, and based on the requirements, okay, we may have to maintain temporary working capital also. For example, if the sales is very high, okay, we will get abundant money pumped if the debtors are paying it in the regular way. And from the debtors' money only we could settle the creditors. Okay, so based on the period given to the debtors, and the period given by the suppliers to offset, we have to maintain the working capital balance. So that is what this chart mentions about. So leaving all these theories, we could get into next video, the problems of working capital management. Thank you.